Hello everybody, it's me the Boss Hog, and today I'm going to talk you through a portfolio review of my portfolio as of the end of May 2021. Let's do it. Okay, so sticking with the same format as last month, basically I felt it was a pretty solid month, at least it finished that way. There was a weird period in the middle, I'm sure everyone experienced it. It was pretty rough. One stage I was down about 1200 quid, so to finish up the better part of 2 grand actually felt pretty good, honestly, considering that's a £3 grand swing, so that was great. I feel like I'm continuing to make improvements in my core portfolio. That said, though, my swing trading this month was not successful. The 2 months previously, I'd made £100 and about 250. This month, actually, I felt like my swing trading cost me 250. So I'm just kind of keeping a mental running balance and trying to be fair with myself. I do really enjoy swing trading, so I want to be profitable about it, but less successful this month for sure. My worst performing stock, I continue to bag hold on. I was actually prepared to let loose and cut it and let go, depending on what happened with their quarterly results, but they were pretty solid quarterly results, more or less exactly where I expected them to be. Revenue better, but costs higher to facilitate that better revenue. So, and the share price went up accordingly. So my worst performing stock is slightly less terrible at the end of May than at the end of April. Dividends did increase, though were technically £32 higher than expected due to a brokerage error, so that was kind of interesting. You can see here on the table on the middle right, my dividend for the month, £187, so pretty good. Only March was higher, but there's a Tesco special dividends of 290 quid in there, so that definitely overrides everything. You can see here as well, my portfolio worth is a smidge under 66,000, and my profit so far since I started is £6,898. So again, broadly speaking, happy with the direction that things are going in, and I'm running ahead of what I hope to be at this stage in my investing. So about 6 months now, actually. Broadly speaking, I'm actually quite comfortably beating the FTSE All Shares Index, which is the comparison, and quite badly underperforming the S&P 500. I think there's some good reasons for both of those things, and I'll delve into those reasons as we go through this video. Okay, so in terms of high-level summary, this is my graph. You can see it is pretty nasty dip. That's halfway through May, and that's what I was just talking about that I think everyone would have experienced. I do feel like my US holdings, I made the most mistakes with when I started, and I am focusing on them. I feel like my UK stocks are already in really great order, to be honest, and that's part of the reason why I'm outperforming the FTSE All Shares. But I am making some good progress with my American stocks. Also, as well, I'm quite actively trying to buy more American shares when the when the Forex is weaker, so when the dollar is weaker compared to the pound, and gradually as a result of that I've been nudging up my sort of blended FX buy rate to be about $1.397 to the pound. Now I'm still down as a result of that on my FX, but basically when it does rebound, as I believe it will, I'll be in a really strong position to profit from the FX movements as well as from the stock movements, so that would be good. Yeah, my UK is largely moving in the right direction. I would say I have 3 UK stocks in particular that are just smashing it, all in the consumer discretionary section, so we'll get to those very shortly. Okay, so in terms of my market summary and comparison, I'm pleased actually with how both my US and UK holdings are going. Even the US, where I'm underperforming, last month I was up 7.8 compared to 14.2 in the S&P 500. This month is 9.6 compared to 14.8. And this is really where I'm hoping to get to, by the end of November, which would be my first year. I'd like to have caught up. A lot of the mistakes I made in my early days, I just took terrible advice from YouTube, invested in companies I didn't really understand at entry prices that were far too high, and I've gradually been reeling in the S&P 500, so I'm basically outperforming for the last few months, but because I was so far behind, I'm still behind, but this is moving in the right direction, and that feels really great. But even the UK really stepped up this month. Again, there was some good reasons for that I'll go into in individual stocks, but that was 12.5% compared to the index of 10.2 last month, whereas this month it's 16.6 compared to the index of 11.1. So yeah, comfortably now beating that. My FX did get materially worse, no doubt about it. But you can see here, you know, that's £719 compared to 140 the month before. But it's just a consequence of the dollar, basically. I tried to manage it as much as I could. I've gradually been buying more American shares, but it is what it is. So right now I'm sitting on an adverse cost of 720 quid. Obviously not realised that yet, so it's just there floating, as it were. And the comparisons here are just on the table on the middle right. And as I touched on the previous mention, my blended average is now about 1.397. But the actual dollar is about 1.41. So that's the difference there. My worst performer continues to be GAN. This had been as low as £500 loss, basically, but following the quarterly results, which were pretty solid, there has been some improvement, so that feels good. And I'll continue to hold on to GAN, actually, and I hope to eventually make some money on them. I still think it's a very viable medium to long-term business. I just got the wrong entry point and learned from it. In my core portfolio, quite a few stocks are in the red, although not by very much. 10 of my 45 holdings are technically red, so I got Workday, Huntsman, this is like a test, isn't it? Telecom Plus, Teledoc, Vistry, On Track, SLP, that's Sylvania Platinum, Apple, and Unity. So most of these aren't too high. In terms of Workday and Teledoc, these are growth stocks that I'm sort of thinking about just getting rid of, to be honest with you. I don't really know how to value them. I think they're both okay businesses, but I think there's money to be made elsewhere. Huntsman I actually really like as a business. It shot up following some dividend announcements about 6 weeks ago, but has gradually been drifting down since. If it drops below 28 again, I'm just going to continue adding. I think at 28 especially, it's sort of 15% undervalued, and it's, you know, a dividend growth stock in my opinion. Telecom Plus is a okay FTSE 250 company. Again, to me, this is like a value play. I just think it should be worth probably about 10% more than it's worth. It's also got 4.5% yield, so that's a nice comfort as well. Vistry, I think, is quite criminally undervalued at the moment. I'm rapidly trying to build my stake as quickly as possible. I think the share price should be sort of mid-20s. I don't really understand why it's a 17, but that's fine. On Track is a bit of a speculative play that somebody recommended, so I just bought a stake. Sylvania Platinum, I got in at quite a high buy price, but I think the company is perfectly fine. Apple, I really like as a company. I have quite a high average up buy price, but I like it. And Unity, I am just adding 20 quid to daily whenever it's loss making, so just a very small stake in that as well. So that's all my red positions as it stands currently. Okay, so in terms of my portfolio risk, just as a reminder, this is fairly arbitrary risk levels that I pinched from PPC Ian, but I quite like it. It's basically a simplified beta, and this is really to stop me either being too aggressive or too risk adverse. The long-term plan is to have 60 to 80% in core, so level 3, and then basically 10 to 20% in both 4+5 and 1+2. So you can kind of see we're already there. And then I'm tracking my performance against that as well. Broadly speaking, this month my riskier assets did better. I actually added quite significantly to my GAN holding. I sold out of Carnival Cruises and basically averaged down aggressively, sort of cut my my percentage in half as a result. Also Genie as well, which is a SPAC, which I think it was a SPAC. I think it's a good company. I think it should be worth in the low to mid 20s. Arguably, it's slightly ahead of itself at kind of nearly 25. But I think it's good that it's getting some love. And then I've opened up a couple of smaller positions as well, which have also started promisingly. So my level 5, the riskiest, has had a pretty good month and is now nearly 6% of my portfolio. Level 4 did slip back a bit. This is just really a result of the fact that I had an incredibly good profit on some recovery stocks. The ones I chose to keep have had a bit of a pullback. I'm not really overly concerned. I think my level 4 has got some semi-risky companies in, and that's perfectly to be expected. Excuse me, just recovering from a weekend bug. Level 3 edged up slightly. These are the kind of core holdings, so again, I'm not expecting massive movement here. And yeah, I'll continue to be fine with where that currently is. Level 2 really saw a big change, and that's really the result of selling out of AT&T. I was really into AT&T for 2 reasons. good dividend, and the HBO growth potential, and following news that they were divesting their HBO arm, to me, it's just the main reason for me being in that company no longer remains. I would say that I'd previously done some valuation and thought the mobile or the wireless side of AT&T was worth about $26, and I understand that post divestiture, the T bit that's remaining is going to be about 24, so there might be a re-entry point for me. I'm going to keep an eye on it, but it just fundamentally changes the reason for me having that business at that price. So time for me to exit, basically. So that was why. Now, I haven't actually got anything in level 2 at the moment. Just is what it is, really. Level 1 dropped back quite a lot. I previously only had 2 companies in level 1, which was National Grid and EPD. National Grid, a UK company, and EPD, an American one. I opened up 2 more positions in VST and TU, TELUS. Now, to my surprise, VST still isn't performing, but honestly, again, I'm just quite happy to build a stake. I do understand that, you know, got battered by the weather and had to take on a bit of debt, but the share price has fallen by about 3 times more than the economic damage caused by that. So to me, it's just a complete disconnect, and that's my favourite time to get into shares, really, when the market just overreacts. So my plan is to build as big a stake as I can with an average price of under $17, just because I think I'm going to get a 50% return at that kind of level. So that's the plan there. TELUS, I actually just think it's a really quality company. Basically, it's in one of my ISAs, and whenever I don't have anything better to buy, I'm just buying TELUS shares. It's up like a few percent at the moment. I'm just going to build a stake in it and not expect to make huge amounts of money in the short term, but I think it's a well-run business, and I'm happy to have it, basically. So as a result of kind of selling out of AT&T, I added especially to Vistry, which is why you can see such a big jump in my level 1 there, basically. But broadly speaking, I'm happy with this split. And yeah, I did pivot. I would say I kind of polarized, actually. So you can see there a big jump in my level 5 for sure, as well as quite a big jump in level 4, and then, you know, sort of level 2 and 1 consolidated, and I guess did decrease slightly. So yeah, overall my portfolio got a little bit riskier, but nothing mad. I'm not like buying SPACs or sort of penny stocks or anything like that, so it's all relative. Okay, so this is my performance by sector. Big increases in my consumer discretionary, transport, utilities, oil and gas, and REITs. Specifically, discretionary, I haven't actually added anything or anything material. It's just my 3 main holdings in Games Workshop, National Express, and Hollywood Bowl have just had a great month. I think they're 3 really good businesses, and I've got reasonable holdings in all 3 of them. Transport was National Express, so I was picking this up at 280. Now, there is some risk with this just because we don't really know what the business is going to look like post-COVID, but actually I read some updated financials, and I was really pleased. Revenues recovered about 75%, and incredibly their earnings were actually up on last year, despite only earning 75% of their revenue, just where they've become more profitable and leaner as a business, which to me is a great sign for when the rest of the business picks up as well. As well as that, they've been picking up contracts over the last year from distressed school buses in particular, and other buses, so I'm really confident about these. I have a buy price somewhere between 280 and 360, which I appreciate is a bit of a range, but that's just where I feel there is a lot of uncertainty. But to me, I got an average buy price of 290 and was picking them up from about 284. So for me, this was just a great buying opportunity, and I heavily increased my National Express holding as a result of that. Utilities, oil and gas is primarily EPD. I just kept buying it under $24, basically. I think my average buy price is just over 23. Again, I just don't think the market's really appreciated the value here, and I'm quite happy to have them as my second biggest holding. And REITs, I picked up what I consider a bit of a bargain for CyrusOne, Cone, $68. I was selling out of other positions to buy at 68. I didn't really understand it. It already recovered about 73 by the end of the month, and I'm convinced it should be about an $80 share. So for me, it's quite unusual to find value in REITs, so that's why I chucked some money into it. I did have big reductions in financials, healthcare, non-discretionary. I would say that my financials and healthcare kind of accidental reductions. I was swing trading Broadcom by selling out of JPM and J&J, and it didn't find a good entry point because they'd both run up. So whoops, I missed some upside there for sure. Regarding non-discretionary, I sold out for Unilever at 4,300. That's an 11% profit for me. I was quite happy with that. I never really loved Unilever, to be honest. I think there's a very good reason why it's traded sideways for 5 years, whilst Procter & Gamble is a much better business in my opinion. I just haven't found an entry point for that. So yeah, I just decided to profit take on Unilever at a pretty good price of 4,300. Excuse me. If it goes back under 4,000 pence, £40, I'll probably get back in just for some profit. But I don't really love the business, and I'm quite happy to had to have sold it for a small profit. Broadly speaking, I didn't really follow my plan this month at all. It was just opportunistic across the board. I think I seized on a couple of good opportunities with VST, EPD, NEX, NEX, Sterling NEX, and a few others. But I also, and I'm not really counting those as swing trading because it's not like they're just me kind of buying more shares, what I consider a good pricings. So yeah, I guess this was it. Like I think I have these plans where I want 20 to 25% tech, and then 15% financials and 15% healthcare. But it's kind of only guidance. And for me, I saw some opportunities and I went for them, and most of them turned out reasonably well, at least so far. We'll obviously see whether I still feel that way in a few months. Okay, now on to dividends. So made £187.06 in dividends. You'll see here on the table to the right that's 2 entries for AT&T. That's because my broker's silly and paid me them twice. They did subsequently take out that money again as a withdrawal, but I just, the data's there now, and I'm just like, whatever. So slight over-reporting. I think as long as I'm honest and understand that, I think it's fine. Doesn't really change the direction, so that's all good from my perspective. Yeah, so I did have reasonable dividends also from EPD and Aviva. This is a British insurer who's going through a bit of a turnaround at the moment, sort of simplifying their business, and I like the way that they're moving. It's quite a well-paid dividend stock, and broadly speaking, I'd recommend that people check out British insurers. I think there's some real quality ones. Maybe I should make a video for it. And the two main ones that everyone owns are Legal & General and Aviva. I have a much smaller position in Legal & General and a much bigger one in Aviva, so that's worth highlighting. So actually, most of the companies I've got a dividend on, I have increased my holding since. So Games Workshop, really love this company, the consumer discretionary owner of Warhammer, but quality numbers all the same. JP Morgan I mentioned already. Bristol Myers, I've increased my holding there to 60. I have a good buy price here of sort of just a smidge over $60 from memory, so it's fine. AT&T I've now sold out of. So EPD I got a really large dividend, but you can see here, I mean, I've almost doubled my holding in them during the month. So I only actually got dividend on 139 shares that I had before ex-divvy, but the next dividend I'm going to get is going to be close to double that, so that'll be pretty awesome. Apple, likewise, I've become increasingly bullish on Apple, mainly because of Joseph Carlson. I think does really good summaries, and I've started to appreciate the fact it's more than just a hardware company, which maybe is how I've seen them before, and I think that's not the right way to see them. So I've been won over by Apple, and I'm rapidly increasing my holding. Aviva, I haven't found an opportunity to add more shares. I'd like to add them under 400 pence, but they keep remaining quite stubbornly around 410. I might soften my approach there, but I think I really want it under 400, to be honest. And Lloyd's is kind of a constant underperformer, but it's been on a bit of a tear since about October last year, almost doubling in price. It seems to be a business that keeps on winning. My only concern is that the really good CEO who's been there since about 2012, I guess 13, he's now left. So I think he deserves a lot of credit. I can't pronounce his name, something exotic, Iberian, and but fine. In terms of my blended dividend is currently at 3.12%. I'm happy. Again, I'm not really wedded to a specific number. I think 3% for me feels good. When I started investing, I had sort of 4.4%, went down as low as 2.8%, and for me, in the 3% feels comfortable in terms of a combination of dividend and growth. I would say though that within my blended dividend, I have stocks that yield close to 10%. And then stocks that actually don't even yield anything. CACI, CACI, is very clear on the fact that it never intends to pay a dividend, but I quite like it as a kind of defense slash IT slash contracting, government contracting type stock. So that's fine, I think, to have different stocks for different reasons. But yeah, broadly speaking, happy with the dividends, right? And I'm hoping I'm going to make £1,000 in the not too distant future since I've started, so that'd be pretty awesome. Okay, and then just to finish, these are my current holdings, profitable, etc. I did increase a couple of stocks this month, just a couple of my more riskier positions, basically, and actually more risk-adverse positions. This is partly just opportunistic, as I deviated from plans, as I touched on earlier. Broadcom, I've already mentioned, and yeah, all of this I think I've already mentioned. In terms of my larger holdings, I decided to almost double my stake in the Hollywood Bowl. This was really just once it became clear the UK economy was going to be opening on May 17th. And I think this is actually, for me, like I'm targeting 400p stock over the next about 2.5 years now, 2.7 years or so. It's just a great business. I really like it, so I wanted to kind of increase my holding before share price increase. EPD I've already touched on. AMD I was really pleased. This was one of those that I haven't touched on yet actually, but this was a completely opportunistic thing. Saw it had fallen to, I think it was $73. I sold out of Cisco and most of Sage, which had been sort of core holdings for me since I started. Profit took solid percentages on both of them. I just felt AMD at $73 was too good of an opportunity to pass up, and within about a week it was 80 again. So that just feels really good. It's a good example actually of an opportunistic buy that I'm really pleased with. Vistry was talking about lots, Huntsman was talking about lots as well. National Express, Apple, Cone, Genie I mentioned about the averaging. Genie is a company that I was averaging down on following some SPAC stuff, and really I was cheered by the fact that they've got a couple of contracts now, and they just seem like they're starting to mature. I mean, they're clearly still a growth stock, don't get me wrong, but you're starting to see vindication of their business, and I'm fairly optimistic now that this is moving in the right direction. It's still a level 5 in terms of risk, don't get me wrong, but I'm starting to understand the business a lot better, and I like the numbers and etc. GAN was pretty exciting for me. I even attended the analyst call, the quarterly results, and again liked what I saw. That was quite a good learning experience for me. It's the first time I've actually listened to CFO etc. In lifetime. And they're very clear about the direction that they're going in. Things are starting to happen as they expected. There were still a couple of shocks. I think there's a couple of some naive points that they made during it that kind of make you a little bit nervous to have, a 4-figure amount of money with them. But broadly speaking, I mean, I like the product effectively is why I'm with GAN. I can sort of take or leave the rest, but it is highly speculative. But I was cheered enough to basically profit take sort of a 35% profit on Carnival and redeploy it into GAN, and that brought down my average to kind of a smidge under $20. So now I'm only on about 20% loss, although that's still 300 quid. So that's pretty significant. I think the rest of the list is here. If anybody has any questions about these, obviously feel free to ask. But yeah, this is as things stood at the end of May, and yeah, that's basically it in terms of my itemized holding. Alright, so that's everything for the end of May. Again, if anybody has any comments, feel free to ask. Any subscriptions, likes, they're always appreciated. And yeah, alright everybody, I'll wrap up there. I've been the Boss Hog, and good luck with your investing.